Discovering undervalued small-cap stocks can be a game-changer for investors seeking long-term growth. Yet, this is a path less traveled compared to the spotlight on large-cap giants. But here's where it gets controversial. Many overlook the hidden potential in smaller companies that boast solid fundamentals, disciplined capital management, and attractive valuations. Today, we dive into 3 such overlooked opportunities: EQT Holdings, ASX EQT in Australia, alongside Steamships Trading, SST.AX, and BK Technologies, BKTI, in the United States. These firms showcase how strong cash flow generation, smart reinvestment strategies, and market mispricing can combine to create compelling investment cases for those willing to be patient and thorough. EQT Holdings, a high-yield energy opportunity riding structural advantages. EQT Holdings stands out as a diversified player in Australia's energy and infrastructure sector, delivering impressive financial results that underscore its resilience. In the second quarter of 2025, EQT reported an operating cash flow of $1,242 million and free cash flow of $240 million, largely fueled by a significant production increase of 100 billion cubic feet equivalent, BCFE, following its Olympus acquisition. While the company carries a substantial debt burden of $8.3 billion, its liquidity position remains strong, boasting $4.1 billion in total liquidity and an EBIT to interest coverage ratio of 10.8 times, which indicates a comfortable ability to service debt. At first glance, EQT's price to earnings (PE) ratio of 45.06 might seem steep, up 153% from its average over the past year. However, this premium is supported by a robust 19.7% year-over-year growth in net income and a strategic shift toward lowering production costs. The company's updated guidance for 2025 includes a reduction in per-unit costs by 6 cents per MECFI, alongside increased production targets, reflecting disciplined operational management. The critical question for investors is whether the market is fairly pricing EQT's capacity to maintain these margins amid the inherent volatility of commodity prices. This tension between valuation and growth potential is where the debate heats up. Steamships Trading, navigating cyclical waves with a volatile valuation. Steamships Trading offers a more complex picture. As a maritime logistics company, SST's PE ratio currently sits at 25.74, which is a striking 157% above the industry average of 10.00. This elevated valuation reflects both optimism about future prospects and the risks tied to its cyclical nature. Historically, SST's PE has been highly volatile, swinging from an extraordinary high of 295.43 in 2018 to negative territory in 2017, making it a stock that demands a strong stomach for fluctuations. Despite this rollercoaster, SST's 2025 performance suggests signs of stabilization. Although detailed revenue figures are limited, the company's EBIT coverage ratio of 10.8 times and reported annual revenue of $177.45 million as of June 2025 point to a resilient business model. The main challenge lies in whether SST can sustain its profit margins amid rising fuel costs and tightening regulatory environments, which are common headwinds in the shipping industry. For investors with a higher risk tolerance, SST's elevated PE might actually represent a mispricing if the company's cash flow proves more stable than the market currently expects. BK Technologies, a tech-focused public safety innovator. Turning to the US, BK Technologies emerges as a promising small-cap technology company specializing in public safety communications. The company's second quarter 2025 results were impressive, with revenue reaching $21.2 million, a 4.5% increase year over year, and a gross margin expanding to 47.4%, up from 37.3% in 2024. BKTI also reported $11.9 million in cash and zero debt, underscoring a strong balance sheet. While some analysts label its PE ratio of 15.62 as overvalued, this perspective often overlooks BKTI's healthy 20.7% EBITDA margin and an upwardly revised full-year earnings per share (EPS) target of $3.80. BKTI's competitive edge lies in its flagship BKR 9000 radio, which commands a 30% price premium over older models due to its advanced features. With federal agencies increasing procurement ahead of the fiscal year end, BKTI's order backlog is robust, signaling strong near-term demand. Additionally, the company's research and development pipeline, including the upcoming BKR 9500 radio, positions it well to capture long-term growth opportunities in the public safety technology sector. Why these stocks deserve a place in your core portfolio? What unites EQT Holdings, Steamships Trading, and BK Technologies is their ability to generate strong free cash flow and reinvest strategically in high-margin assets. EQT is focused on reducing debt while growing production. SST demonstrates resilience in earnings before interest and taxes, EBIT, and BKTI continues to innovate with cutting-edge products. These factors contribute to durable competitive advantages that can support sustained growth. Investors must strike a balance between skepticism about current valuations and optimism about future growth. EQT's elevated PE ratio could normalize if oil prices stabilize, while SST's valuation volatility requires a patient, long-term investment horizon. BKTI offers a compelling mix of immediate cash flow and promising future prospects. Historical data from earnings releases between 2022 and 2025 reinforce the potential benefits of a buy-and-hold strategy with these stocks. EQT Holdings showed a 70% success rate in generating positive returns within 30 days post-earnings, averaging a 2.71% gain in the 10-day window after announcements. Steamships Trading and BK Technologies performed even better, with average 10-day returns of 5.49% and hit rates of 68.42%. While earnings dates alone aren't foolproof indicators, these patterns suggest that patience has historically been rewarded, with maximum returns ranging from 11.42% to 14.75% within 56 days of earnings releases. Final thoughts. Are these small-cap gems truly undervalued or just risky bets? Investing in small-cap stocks inherently carries more risk, but it also offers the potential for outsized rewards when focusing on companies with strong operational execution and capital efficiency. EQT, SST, and BKTI are not merely undervalued, they are often misunderstood by the broader market. By capitalizing on their structural strengths, EQT's energy infrastructure, SST's maritime logistics expertise, and BKTI's innovative public safety technology, investors can assemble a diversified, high-conviction portfolio with the potential to compound wealth over the next decade. That said, due diligence remains paramount. Keep a close eye on debt levels, margin sustainability, and regulatory developments that could impact these companies. And here's the part most people miss. Are these stocks undervalued because the market is cautious for good reason? Or is there a genuine opportunity that savvy investors can exploit? What's your take? Do you see these small-cap names as hidden treasures or risky ventures? Share your thoughts and join the conversation below.